Inflation in the US reached a new 40-year high in June, and it continues to gain ground and top expectations. Consumer prices in June climbed 1.3%, with year-over-year inflation rising 9.1%, its highest since 1981. Higher gas and food prices were the biggest contributing factors. Again. And despite the Federal Reserve's efforts to tame rising prices over the past 7 months, inflation isn't showing any signs of slowing down. The Fed just hiked rates again last week, its second consecutive 75 basis point increase. This brings its benchmark rate to a range of 2.25 to 2.5%, its highest since 2018. Hi, I'm Matt, investments writer for Finder.com, and welcome back to the channel. Today, we'll talk about the Fed's most recent and future rate hikes and what they can mean for your portfolio and some investment moves you might want to consider. According to Fed Chairman Jerome Powell during his most recent press conference,
another unusually large increase could be appropriate at our next meeting,
depending on the data that comes out between now and then. The board will meet next on September 20th and the 21st. We'll have 2 more consumer price index reports released between now and then, as well as numerous other economic reports and indicators. So let's talk about the Fed rate hikes. But first, if you're new to this channel, please consider liking and subscribing so that you'll get notified every time we drop a new video. And as a side note, I don't own any stock in any of the companies mentioned in this video. So what exactly is the federal funds rate and what does it do? The federal funds rate, or Fed funds rate, is the overnight lending interest rate that banks and credit unions use to lend each other money. But why would a bank need to borrow money from another bank? A bank's daily operations, which can include cash withdrawals, cash deposits, lending money to customers, can cause the bank to have a shortage of money at the end of the business day. When that happens, another bank with excess reserves will lend that money to a bank that needs to balance out the day's transactions or meet reserve requirements. The Federal Open Market Committee, or FOMC, sets the rate at which it wants these banks to charge each other when they make these overnight loans. The FOMC meets 8 times a year to determine the Fed funds target rate. This target rate is highly influential over other interest rates. Through the prime interest rate, changes in the Fed funds rate often triggers a ripple effect in everything in your daily life that has to do with interest rates. This includes things like your credit cards, mortgage payments, interest earned on a savings account, and even taking out a loan. So now that we've gone over what the Fed funds rate is, why is it going up? The Federal Reserve may decide to raise the Fed funds rate in an attempt to slow down the economy and tame inflation. Now, you might be thinking, why would a fast rising economy be a bad thing? Because it's growing so fast that demand for goods is outpacing supply and driving up prices, making things like housing and food more expensive. Now, higher interest rates make borrowing more expensive and saving more enticing. This dampens consumer and business spending, which in turn slows down the economy and ideally reduces inflation. Fed officials began expressing growing concern about surging inflation back in November 2021 when strong consumer demand at the time outpaced supply, and inflation ran at levels higher than the Fed's objectives, largely triggered by the pandemic-fueled supply chain disruptions that still very much affect global markets. The Fed said at the time that they'd be willing to raise interest rates if prices kept rising. Fast forward to March 2022, and those supply chain disruptions, higher energy prices, and the onset of the war in Ukraine culminated in runaway inflation. That very same month, the Fed issued its first rate hike since December 2018, a 25 basis point increase in the Fed funds rate. The Fed has since ratcheted up its measures to combat rising costs, as inflation shows little sign of abating. The Fed has increased its target rate 4 times in 2022 and plans to keep the pedal down to counter the fastest pace of inflation in over 40 years. So what does all of this mean for you, the investor? Well, it depends on what you're investing in. Generally speaking, high inflation and rising rates tend to hurt the performance of stocks, even though rates don't directly affect the stock market. In periods of rising rates and inflation, both people and businesses tend to cut back on spending, which can diminish earnings and cause stock prices to fall. And that seems to be happening for the most part. In June 2022, the Dow Jones Industrial Average hit a low of just under 30,000 points, a 19% decline through the first half of the year. Similarly, the S&P 500 fell 24% through the same time period, and the tech-heavy NASDAQ lost a whopping 33% of its value, hitting a low of 10,565 points. Of course, not all consumer spending ceases during periods of rising rates. People still need to spend money on necessities like food, healthcare, and fuel, among other things. As a result, these sectors tend to remain stable through all phases of the economic cycle and are seen as defensive plays during periods of rising inflation. To illustrate, the energy sector, which is composed mostly of oil stocks, is up 41% in 2022, while the utility sector is up 3%. Losses in the consumer staples and healthcare sectors are minimal compared to technology and consumer discretionary sectors. Do sectors always move this way? No. There's no predicting the stock market. But according to data from Capital Group, these defensive sectors have outperformed the S&P 500 more than half the time during the last 7 market downturns through 2018. What about bonds? Interest rates and bond prices tend to move in opposite directions. When interest rates rise, prices of fixed-rate bonds fall. This is known as interest rate risk. Why? Supply and demand. New bonds coming onto the market with higher yields reduces the value of existing bonds issued at lower rates. And as a result, people may decide to sell their current bonds to purchase the higher paying ones. This selling can drive down prices and negatively affect bond portfolio's value. But if you plan to hold your bonds until maturity, despite the arrival of more lucrative options, interest rate hikes and falling bond prices may not matter all that much. While the Fed's rate hikes make spending more expensive, they make saving more rewarding. And if you have a high-yield savings account, you've probably already noticed a significant hike in your account's APY. Yields of bank deposit products like savings and CDs are on the rise as the Fed raises rates to combat inflation. And this allows investors to earn more money on their idle cash. But not all savings accounts are the same, so it's important to make sure you park your cash in the right place. For instance, right now, the national average deposit rate for a typical brick-and-mortar savings account is still a meager 0.10% APY. Meanwhile, a high-yield savings account with SoFi pays 1.80% APY. That's a big difference. So if you aren't saving with a high-yield savings account, you're simply leaving money on the table. So consider ditching those low-paying savings accounts and put your money to work as interest rates continue to climb. So what should you do with all this information? And just a general disclaimer, I'm not a financial advisor, so none of this information should be taken as advice. But here are some investing tips to best weather and possibly benefit from the market effects of the Fed's interest rate hikes. First, consider rolling back debt. Variable rate debts will likely get more expensive as interest rates go up. This includes credit cards, adjustable rate mortgages, home equity lines of credit or HELOCs, and private variable rate student loans. So if you have credit card debt and carry a balance from month to month, you might see your interest rate go up in the next couple of billing cycles, if you haven't already. And while borrowers already locked into fixed rate financing on a vehicle won't be affected, new car loans will also likely go up in cost. Debt will be getting more expensive, so now would be a good time to focus on reducing it. Number 2, consider shortening bond duration. According to the Financial Industry Regulatory Authority, or FINRA, duration is a measure of the degree to which a bond investment is likely to change in value if interest rates were to rise or fall. As a general rule, for every 1% change in interest rates, a bond will rise or fall in the opposite direction by an amount equal to every year of duration. So if a bond has a duration of 10 and interest rates rise by 1%, then that bond's price will fall by approximately 10%. Bonds with a shorter duration then are less sensitive to changes in interest rates. In general, the higher the coupon rate, the lower the duration, and the longer the maturity, the higher the duration. Asset management firm AllianceBernstein recommends that investors that want to limit risk limit duration. Shortening duration, they say, can help mitigate volatility and losses as interest rates climb. Number 3, seek out stocks with dividend growth. Investors looking to shift their portfolios to go on the defensive should consider companies that are well poised to weather rising costs and have a solid history of dividend payouts. These include large cap staples like PepsiCo, Costco Wholesale, and Procter & Gamble. Bank stocks, which directly benefit from rising rates and many of which pay dividends, should also be on your list. This is especially true now that many have pulled back significantly in price in the last few months. This could represent a buying opportunity for stocks that have significant earnings upside from the Fed's rate hikes. And while dividends in general help investors keep up with rising prices, Fidelity tells us that stocks that increase their dividends during periods of high inflation tend to considerably outperform the broader market. That's it for today. If you like this video, please subscribe to the channel, and I'd also love to hear from you. What moves are you making as the Fed raises rates? Please leave your thoughts in the comments section below. Good luck as always, and we will see you next time.